Welcome back to the channel, guys. I thought I'd do an interesting video on the backtesting paradox. What do I mean by that is we often hear the word past performance does not guarantee future results. So why do we bother looking back at all then? So what does the disclaimer really mean? This is a legal disclaimer, it's a crucial warning. It means that the market conditions, economic factors, and global events are constantly changing. A strategy that worked perfectly during a 10-year bull market might fail completely in a recession. The future is not just a simple repeat of the past. So, in this case, why do we bother backtesting then? Backtesting isn't about finding a crystal ball. It's about being a historian and a scientist. So we look back not to predict the future, but to understand risk, behavior, and probability. It's the process of refining an idea against historical data. So the backtesting workflow from idea to insight. So the idea, I believe tech stocks outperform a 10% dip. So we go backtest it, apply this rule to historic data, e.g. from 2000 to 2020. We then analyse, did it work, how often, what was the biggest loss, typically drawdown, and then refine and test. It only works for large cap tech. Let's retest. So what the past can tell us, it provides a baseline for a strategy, almost like a personality. So volatility, how bumpy is the ride? Risk profile, what's the worst case loss, max drawdown? Behavior, how does it perform in different regimes? Bull markets, recessions, sideways markets. Probabilities, how often did it succeed or fail? What's the past can't tell us? It can't predict events that haven't happened before. So black swan events, unpredictable events, new inventions, global pandemics. Regime changes, a sudden shift from low to high interest rates. The exact future, it provides probabilities, not certainties. Obviously, then there's the biggest factor in the markets, quite often human emotion, how you will react, the real money, when real money's on the line. So in terms of the biggest pitfall fitting, this is the danger of backtesting. It's when you tweak a strategy to perfectly match the past. Makes it kind of useless for the future. It's like memorizing the answers to an old test you have learned the subject for a new test. So backtest versus reality is the overfitting trap that we all fall down. So a key takeaway, the perfect backtest is the yellow line, which was tuned so precisely to past data that it failed immediately when faced with the new sort of live market conditions. And so it's not just one past, right? Historical data isn't a single thing. Different investors analyze history through various vastly different lenses. And kind of three main approaches that I kind of want to look at here. And they start off with, think of these as like the primary lenses, like famous investors use to see the market. A very popular investor that we all have probably heard of is Warren Buffett. And he's an icon of fundamental analysis, digging into a company's books. Where there are other investors like Paul Tudor Jones built his legend on technical analysis, reading the tape and the market psychology. Then you got Jim Simons, a pioneer in quantitative investing, using mathematical models to find patterns invisible to the human eye. And this radar chart kind of shows the lenses and the focus. So if we look at it from a technical analysis, it's highly focused in terms of the way it approaches things. When we look at fundamental analysis, it's much broader. And then when we look at quantitative investing, it attempts to consume all the available data types. So in terms of the data types, we've got price and volume data, financial statements, economic data, market sentiment, and then other data like news and things like that could all have a factor to play. So if we were to break these out now and look at the core concepts of each of these. So technical analysis. So the core premise is market price reflects all information, investor psychology is repetitive, and creates recognized patterns. So the use of historical data here analyzes historical price and volume charts to identify trends, patterns, support and resistance levels. So the analyst toolbox, if you like, is the chart patterns, head and shoulders, sometimes referred to, price trends, moving averages, relative strength indexes, and MACD. So these are commonly used by your day traders, your swing traders, timing basic options trades. However, this does have an Achilles heel, right? Can become a self-fulfilling prophecy. Past patterns may not repeat in the same way. And this is quite often why we see day trading and swing traders typically make a lot of money as well as lose a lot of money quite quickly. If we start to look at more fundamental analysis, so the core premise here is a security has an intrinsic value based on its underlying financial health and its economic conditions. So use of historical data here examines historic financial statements, income, balance sheets, cash flow, debt, to forecast future earnings and assess value. So the analysis toolbox here might be P ratios, return on equity, debt to equity ratio, revenue growth, and profit margins. Commonly used for value investors, e.g. Warren Buffett, growth investors, dividend, and income investors. So the Achilles heel here is valuations are subjective and based on assumptions, can be slow to react to new market sentiments. This is really digging deep, and you've got to be really patient when you're in this kind of investing mode. Now let's look at the quantitative investor. So the core premise here is looking at markets containing statistical identifiable and ultimately exploitable patterns and inefficiencies. So the use of historic data here uses vast historical data sets, price, fundamental, alternative to build and backtest mathematical models. The analyst toolbox here is factor exposure, value, momentum, statistical arbitrage spreads, options volatility modeling, e.g. the Greeks, which again I've done a video on if you haven't seen that already, machine learning models. So commonly used for algorithmic, high-frequency trading, complex option strategies, and risk factor modeling. Now, again, there is an Achilles heel for this, although it has the most broadest in terms of how it works, which we saw earlier. It can be overfitting on past data, so it's vulnerable to the black swan events, not in a historical data set. So it still has vulnerabilities despite earlier seeing that it had the maximum spread in terms of what it looks at from an analysis perspective. Okay, so what's the verdict here in terms of a balancing act? So the statement is 100% true, but looking back is essential. Ignoring the past is like setting sail without a map. Relying only on the past is like using that map in a storm, expecting the sea to be calm because the map says so. So the do's here are use the past to test ideas and understand risk, focus on strategy logic, not just the final return number, test across many different market regimes, bull, bear, sideways, but don't assume that future will look exactly like the past. Don't overfit your model until it looks perfect. Believe any strategy that's never lost money in a backtest. So thanks for watching, guys. Hopefully this kind of was an illustrative, again, for education purposes only. None of this is always counts as financial advice, but hopefully gives you a flavor of the different styles of investing and why that statement's often used. Let me know in the comments on your thoughts around this. I'll be curious to see what people's thinking around this is. Thanks again to the 100% Club for getting to the end of the video, and I will catch you on the next one.